The cheapest property you find could become the most expensive mistake of your life. You are about to buy your first investment property, not your dream home, not a place chosen because you love the kitchen or can picture yourself relaxing in the backyard. This property has one job: to make financial sense. Before searching through listings, you must understand what you can actually afford. You check your income, credit, debts, and available savings. Then you speak with several lenders instead of accepting the first mortgage offer placed in front of you. The interest rate matters, but it is not the only number. You compare the monthly payment, lender fees, mortgage insurance, estimated property taxes, and total cash required at closing. A bank may approve you for a large loan, but that does not mean the property will be a safe investment. Your goal is not to borrow the maximum amount possible. Your goal is to buy a property that can survive vacancies, repairs, and unexpected expenses without destroying your personal finances. You separate your money into three categories: the down payment, the closing costs, and the emergency reserve. That reserve is critical. If the water heater fails immediately after closing, the tenant will not care that you used all your savings to purchase the property. If the home sits vacant for 2 months, the mortgage will still be due. You need enough cash left after closing to handle problems without relying on credit cards. Now you define your strategy. Are you buying a single-family rental for long-term tenants? A small multifamily property where you live in one unit and rent the others? A property that needs renovations? Or a stable home that can be rented immediately? Every strategy requires different amounts of money, time, and experience. For a first purchase, simplicity can be valuable. A beautiful bargain requiring major structural work may be far more dangerous than an ordinary property in good condition. You begin researching neighborhoods. The cheapest area is not automatically the best investment. You look for evidence of real rental demand. Are there jobs nearby, schools, hospitals, public transportation, or universities? How long do rental listings remain available? What are similar properties actually renting for? You do not rely only on the seller's numbers. You compare active rental listings, speak with local property managers, and study recently rented properties that closely match the one you are considering. Then you find a possible deal. The asking price is $250,000, and comparable homes appear to rent for $2,100 per month. At first, the property looks profitable, but rent is not profit. You subtract the mortgage payment, property taxes, insurance, possible homeowners association fees, routine maintenance, large future repairs, property management, utilities you may be responsible for, and an allowance for vacancy. You also investigate whether local rental regulations, permits, or special inspections apply. After all expenses, perhaps the property produces only a small monthly surplus. That does not automatically make it a bad deal, but now you understand the truth. A property can collect thousands of dollars in rent while producing very little usable cash. You ask another important question. What happens if the rent is lower than expected or the repair costs are higher? Good investing is not based only on the best-case scenario. You test the deal under pressure. 1 month vacant, a lower rental rate, a major plumbing repair, higher insurance. If one unexpected bill makes the investment collapse, the margin is too thin. When the numbers still work, you prepare an offer. Your offer is not based on excitement. It is based on the property's condition, comparable sales, and the return you need. Whenever possible, you include protections that allow time for financing, appraisal, title review, and inspection. Once the offer is accepted, the real investigation begins. You hire an independent home inspector. You pay close attention to the roof, foundation, plumbing, electrical system, heating and cooling equipment, water damage, and safety concerns. Cosmetic problems are visible. Expensive problems often hide behind walls, beneath floors, or inside aging systems. Depending on the property, you may need additional specialists for sewer lines, pests, structural concerns, or environmental hazards. The inspection report is not simply a list of reasons to panic. It is a financial document. You estimate the cost of immediate repairs, future replacements, and ongoing maintenance. Then you decide whether to continue, renegotiate, or walk away according to the protections in your contract. Walking away from a bad property is not failure. Buying it because you are emotionally attached is. While the inspection is happening, the lender orders an appraisal. The appraiser is checking whether the property supports the price being financed. An appraisal is not the same as an inspection. The appraisal protects the lender's collateral. The inspection helps you understand the physical condition you may soon own. You also review the title work to identify ownership claims, unpaid obligations, or restrictions attached to the property. Before closing, you receive final loan documents showing your interest rate, monthly payment, closing charges, and cash required. You compare them carefully with the earlier estimates. You question anything you do not understand. You independently verify wiring instructions because real estate transactions can attract payment scams. Then, closing day arrives. You sign the documents, transfer the required funds, and receive the keys. But purchasing the property is not the finish line. Now you must operate it. You complete repairs, document the property's condition, and prepare it for tenants. You study fair housing requirements, local landlord rules, lease terms, security deposit procedures, and habitability standards. You screen applicants consistently using lawful criteria, income verification, rental history, credit information, and background checks where legally permitted. You do not simply choose the person who seems friendly. You choose through a documented process applied fairly to every applicant. Once the tenant moves in, you treat the property like a business. Rent and expenses move through a separate account. Receipts and records are stored carefully. Maintenance requests are answered quickly. You plan for taxes and consult qualified professionals about deductible expenses and depreciation. Months later, the rent arrives. You pay the mortgage and operating expenses. A portion remains. It may not make you wealthy overnight, but the tenant is helping support an asset you control. You have also gained something more valuable than 1 month of profit: experience. You now understand financing, inspections, leases, repairs, tenants, and risk. Your first investment property succeeds not because you discovered a secret house nobody else noticed. It succeeds because you refused to let excitement replace mathematics. You bought with reserves. You inspected what you could not see. You prepared for bad months instead of assuming every month would be perfect. And you learned the rule that protects real estate investors from their most expensive mistakes. Never fall in love with the property. Fall in love with a deal that still works when reality arrives.